So what is task B, right? I guess let's start there. The purpose of what we're trying to teach or get across in this workshop is how do we use the PRI, the time during the PRI, to prepare us for the IOD, and how do we then, when we engage with the PRI, prepare for the IOD, when we engage the IOD, structure our answers, right? We keep speaking about all these wonderful skills, critical thinking, business acumen, adaptation. How do we bring this across, right? So we're going to try to address that. Um, Task B, I think, is incredibly rich in a lot of these skills. Task B is this task that spoke to. So the PRI, maybe first step back. The APC of December 2023 spoke to on-time airline. So we were working, or a candidate who's just joined an airline entity. We were given background about this entity, and the PRI, or the part of the PRI which specifically related to task B, told us that the entity had recently lost a senior accountant, and a certain consulting company, had been brought in to perform certain calculations to support the current accounting team. However, we would be required to review these calculations. And the specific calculations were mentioned. That was the capitalized assets and the impairment thereof, as well as maintenance costs. So from there already we could see, right, where we're going, which standards we need to study or focus on. And we also knew, or we had a feel of what the task would be, because we're told we're going to need to review this. So we're going to speak about how then we should, in the reflection video, we speak in a lot more detail about how to approach a PRI. So I won't spend too much time on that right now. I'll just quickly or briefly just remind us what we need to think about, right? So when we thought about what are the capitalized assets, we knew from reading the background information that it was mostly the leased airplanes, right? So we knew that there were some ROU assets that we needed to worry about there, but we were more worried about the impairment thereof, which meant that's more subsequent measurement consideration. And if we think about IFRS 16 says about subsequent measurement of ROU assets, is that they're measured in terms of IS 16. Then we were told in the PRI that OTA's policy, accounting policy for measurement of their assets, including ROU assets, is a cost model, right? So we've already got a linkage from IFRS 16 to IS 16. Meaning we need to understand how the cost model has applied. So there we need to understand concept on the useful life, depreciation method, residual value. We knew earlier on as well, it was the discussion on maintenance costs. So we need to think about maintenance and which kind of maintenance costs are expensed, which maintenance costs are capitalized, what are we thinking about there, right? So we've got a very clear linkage between IFRS 16 and IS 16. We also know that, we started off knowing that we're doing impairment, or we're going to review an impairment calculation. So we know that there's going to be an impairment leg, right? So with those little two bullets, because that's really where the crux came, those two bullets in the email, we knew we had at least three standards to look at. We knew they're interlinked. And I think in this particular task, on this particular trigger, they helped us with that. One of the things I think really helps during the PRI is when you identify a trigger, you might have, like, for instance, an I-36 trigger. A standard like I-36, just naturally by its nature, links to other standards, right? Because for you to be able to impair an asset or determine whether an asset should be impaired, you need to firstly determine the carrying amount of that asset, meaning you need to understand the underlying standard which speaks to that asset, right? You need to know how to subsequently measure it to determine the carrying amount of that asset. So I-36 naturally integrates to the asset standards. So that's a skill I want us to practice, that even if it's not directly told to us that we need to look at IS 16 or whatever, or look at PPE, if we're required to do I-36, we'd need IS 16. Similar with other standards. The standards don't exist in isolation. A lot of standards link with other standards. Um, I mean, financial instruments is just one of those, for instance, topics that just goes across. I mean, it's got three standards of its own, just on presentation, measurement, disclosure. It's just on its own, speaks to three different standards. But what I want us, or what I think a skill you need to get used to, is when you're reading or when you're working through this triggered standard, this triggered main standard, identify the linkages with other standards. Um, then the areas which link to other standards, try to envision what kind of questions would come in that. So include that in your what ifs. Think of the linkages with other standards because that will prepare you for the surprises that might come on the day. I'm not saying spend all your time now on these funny linkages, but ensure you understand them, right? Ensure that it makes sense to you. Ensure you understand how they interplay. Then you won't be so shocked when they come on the day. Okay? Um, so the integration is natural with I-36. It also naturally requires you to understand business context, but we're going to get there. All right. So you saw here, I broke down a little bit of what IFRS 16 you need to worry about, subsequent measurement, a little bit of what you need from IS6, IFRS 16, IS 16. IS36 was the main trigger, right? Because you need to do an impairment or review the impairment thereof. And IS36, again, such a rich standard. So many things to worry about, so many things to think about. Um, we need to be able to identify impairment indicators. We need to know what that is, right? We need to know which assets do we need to wait for an indicator of impairment before we test for impairment, which assets are tested for impairment every single year. We need to know there's internal indicators, external indicators, and that's where business context starts to come into play with this. Because IS36 will give you certain items that could indicate impairment, but when you then look at, okay, that's all great and well, but when I apply this to the industry, so I'm looking at OTA, what are they telling me about OTA? Are they saying there's a struggle somewhere? Are they saying the revenues are struggling? Is there additional competition somewhere? Apply it to the actual industry. This is why we give you the industry information. So we give you the competitors so that you can actually go and understand what is actually going on, what is happening economically, what's happening for this fictitious company we've been given, what's happening with their competitors, right? Understand how to determine cash generating units. What is a CGU? How do I identify one? Okay, all of that stuff you can read, you'll be able to read in the and listen to all the discussion in the reflection video. But what I want to emphasize here is when you look at the competitors app, so there'll always generally be a list of competitors like, oh, the competitors are FlySafe, Lyft, etc., etc. When you are engaging with the financial statements of those entities, go then and look at how do they identify CGUs? What are the judgments they've used? Because then it teaches you how this particular standard is applied in the context of this industry. What are the judgments they apply? And when we say critical thinking, as you're reading this, assess it against your own understanding. Like, does it make sense? Are these judgments making sense? Do I understand them? Am I questioning them? Would I have made a different judgment? Because that's actually why we disclose judgments. So enable users to make their own minds up, to say, would I have made the same judgment? And if not, how do I adjust what's been told to me here? All right. So read the financial statements so I understand how do they apply 36 here. All right. What is the recoverable amount? It seems so basic, right? It's the high of fair value less cost to sell or value in use. So basic, so easy to forget, and a lot of people did forget it when they were actually answering task B because it's so obvious. But you need to get so acquainted with understanding the most basic principles. When it's missing, you question it, you ask for it, you require more information on it. And then obviously the easy part is what is an impairment loss? When the carrying amount exceeds the recoverable amount, and what are the limitations on applying an impairment loss? Okay. So impairment, beautiful, big standard, lots to think about. Yes, I probably believe it will be shared. If not, it hasn't been shared already, given this PowerPoint presentation. Or it might be shared in a PDF format, but if it hasn't been shared, I believe it will be shared shortly. So this is the breakdown of how to think through the standard, and the cool thing about IS36 is actually all the stuff is actually presented like in the bold. Like a lot of the principles are presented in bold. So you just go through it, right? If you forget what they say about estimated cash flows, you can actually just go back to the standard. But for you to be able to do that during the course of the exam, you need to know where it is. You need to be able to refer to it quickly. Okay? So um so ideally understand what you understand. I mean, the trigger for IS-36 was big. It was broad, it wasn't limited, unlike IFRS 16, which was more subsequent measurement for this task. IS-16 also subsequent measurement for this task. Those are more limited. The impairment was wide, meaning you had to make sure you understand the standard. And very, very key, understand it in the context of the industry and understand it in the context of the entity. Because it's given you the background. Okay? Just a reflection, quick things. Have you made the links? Have you assessed what kind of judgment calls are typically made here? Do you have an expectation of, okay, if an entity in the airline industry has a lease, what do I expect to see? What amounts am I expecting? How are they treating their maintenance costs? Is it a dry lease? Is it a wet lease? When they're discussing their impairment, and this is very key because a lot of the disclosure requirements is just application. And you can see it so beautifully in the financial statements when they explain to you, okay, we have used this discount rate. Does someone have a question?
Like you're breaking. I'm not sure if it's my side.
Sorry, am I breaking?
Yeah, this side seems like you're breaking. I'm not sure if it's my network or that side.
Guys, am I breaking? Can everybody else hear me, or am I breaking for everyone?
I can still hear you.
Loud.
We can hear you.
Can hear you
Okay.
loud and clear.
All right, cool. Thank you guys. Nkosinathi, yes, I am showing a presentation. Noktula, if you did not think of CGUs, it would have cost you probably an indicator. So yes, it would have affected your overall performance. If you thought of everything else, it might have helped you. But yeah, there was some question about whether or not there was a point where we expected you to question whether or not the CGUI was identified correctly. But that again, that would require that you had thought about it. But if you had missed the identification of the CGUs, it would not on its own have led to you not succeeding in this task. There were many, as I said, it's very rich. It was a very rich task. There were lots of things to consider. So you could have still passed even if you didn't specifically ask or question the CGU identification and the asset. Yeah, the CGU identification. Then there was a part of identifying the CGUs, but also asking about the assets that were put into the CGU. So there were a few elements, depending how much of it you did consider or didn't consider, it would have affected your performance. Okay, so again, this is all unpacked quite in a lot more detail in the reflection videos. But now it's just remembering this, right? During the PRI period or those 5 days, you're making sure you understand this technical, you understand how it applies to OTA. When you come and sit down on assessment day, this knowledge is here, right? You are so well acquainted with all the information in your file. You are able to refer to it easily. It is personal to you. You are now sitting there and you are ready for impairment. You're expecting an impairment question, or an impairment task. My apologies. Remember this. Remember all of this. Very key is you have now got an understanding of applying it in the industry. So you've got the business context. You've understanding how the industry works. You've got understanding how leases are treated in this industry, how impairment is treated, how the judgment call that I made. You've understood the integration between leases, PPE, or subsequent measurement in terms of PPE, I-36 and impairment. And you've considered how it might play in with other disciplines, right? You've considered, okay, are there some math principles I can bring into this task? I like impairment is beautiful. It's actually a very well-rounded standard. So you're considering, are there other disciplines I can bring in here? Are there principles from there that I can bring in? Which principles should I leave out? Right? So you've gone through this process. When you're sitting on the day, you've got this. Don't forget it. Right? We need to integrate the work we do in those 5 days to what we do on the actual assessment day. When you read the IOD, you're ready. Remember, you're ready. You've got this. You've done it. You're ready. Now onto the actual IOD. So document B. this is where we now start to read the way the task, the IOD gives information on what task B requires from us. This is the initial email. Before I So if anybody's ever attended one of my lectures or seen one of my slides are they move. There's always animations in my slides. So before my animations take over and highlight what I would have taken as important or key things to note, I want to open the floor to you guys to say when you read document B or this part of document B, right? The initial email. So just this email, what is it that you took out? What did you think were the key takeaways that you need to make note of in this email? Absolutely anything, guys. Absolutely. We aren't even in the technical yet. We're just trying to frame what we're going to do. And guys, there are over 300 of you here. I can't speak to myself. Bongi, please.
Good evening, Kanye.
Hi, Bongi. How are you?
I'm good, thank you. So my key takeaways were, firstly, I've been asked to review review means going line by line on the calculations that have been given. So I would look at what is incorrect technically, what has been omitted, from the information that I've been given, what is relevant and is it reasonable? And then if I can, where possible, I should recommend the correct things. Thanks.
Love it. Thank you, Bongi. Thank you. Very key things to pick up there that in a review task, we focus on what is incorrect. We move line by line, so we ensure that we can get coverage. We look for also in your omissions, as well as if the information provided is reasonable. Love it. Rachel?
Good evening, Kanye.
Hi, Rachel.
So to add on to the previous speaker, there's also another component that I noticed that I missed, which was if you have any additional questions that you need to ask for for information that you may require in order to conclude on the accounting treatment. So that one means that I must have been a subject matter expert for me to be able to identify which parts of the information actually are not complete or where I then need to ask questions. So I believe that counts for a competent response, and maybe that's why I didn't get that competent response the first time, because that's the component that I missed. And also how I phrased my responses. It was always from a review perspective, and I would give recommendations rather than asking questions. When they said we must ask the question, you must ask the question. So yeah.
Okay, Rachel, that's very, very good as well. Very key to ensure you cover all the components of the task, right? Review was one component. Asking for additional questions, another component. You cannot get a competent response if you only address one component. You have to ensure to be competent, you've identified all components and you've addressed all components. And that's even to get a BC response. If you don't address all components, you will not even be BC because you have not delivered on what was asked of you. You have not provided what was asked of you. You have not understood it. So very, very key there. I love the thing you said about being a subject matter expert. I think just generally to be any kind of review task, test for you to actually perform an effective review, you need to understand the technical. You will never identify that something is wrong if you don't know what was right. All right. If you did not spend enough time understanding the standard and understanding the context of this entity, you won't identify that something's wrong. So being a subject matter expert is absolutely key in any review task. Absolutely love that. Nyanyana, go for it.
Hi, Kanye. So also in terms of the review, you would compare the information which you got in the PRI versus the IOD. For instance, you'd look at the depreciation value which you got in the PRI versus what you got and question why is it different from the one which you initially got.
Love it, right? Test current information against existing information. So question, that goes back to the critical thinking. Question, what was provided against, or what's been provided in the IOD against what was previously provided in the PRI. That also speaks to your ability to critically think, critically read, critically assess. Like, is this consistent with my understanding? Is this consistent with my knowledge? Is there a reason why it has changed? Does the change affect my answer? Should I be questioning it? What does it mean? Right? So very, very key. Test the information provided against existing information. Someone else had their hand up. I don't know if you still want to go.
Hi, Kanye. It was me. I think the ladies
Adam.
have covered everything I wanted to ask. Just with the second components, just wondering, would you recommend that if you're asking questions to separate it? Because what I did in my response was I asked the questions as I was reviewing it. And when I got the task back, they said I didn't address all the components. So should I have split it so that it's clear? Or because, yeah, that's just what I wanted to find out.
Okay. So you don't have to split it, right? Obviously, if you do split it, it is easier for people to see. I would split it simply for me to remember. So when I'm planning how to address this task, I would identify the components and have different headings so that I can, so that when I come back to it, I know what to do. I don't forget any components. So I would split it for my own benefit to make sure I don't skip any component of it as I'm rushing. Because sometimes you do find yourself trying to work through and then you get caught up and forget something. So I would do the different headings for that purpose. Also, yes, it does make it easier for the markers to identify the different components, but it's not a prerequisite that you do it separately. If the questions are there, I think they should have been able to identify it. I'm not sure why they still felt you didn't address other components, but if the questions are there, they should have been able to pick it up even without the different split or the different headings.
One that's not cracked and dies out on you when you're on the phone. Here's a cracked for you. Phone me out as a
Mandumbi, please mute. Thank you. Alrighty, cool. So I think we covered a lot, right? So one of the things we keep saying that don't forget the PRI, don't forget the PRI. So I think this was very nice of them, right? When the first sentence they talk to you about attaching the FY 2023 calculations prepared by Greg and Rashid Consulting, see my email of last week. This is like a reminder to you, right? A reminder to you to say, hey, remember we've discussed this. Don't forget the information I gave you last week. Don't forget the information you've worked on in the past few days. So this is a kindness, but they don't need to do this because you should be naturally drawing on prior knowledge when you get to the IOD. Right? Here we already discussed this. The key doing word here was we're going to review. We are told that we're going to do a review and we're going to email any comments. So we know what the structure is, right? We know what the structure is. We're going to provide an email format, and that's going to help us with our communication competencies, right? Ensure that we're communicating clearly and in the manner requested. Then here, that's what we're looking at. What am I reviewing? What should I review? I know I'm reviewing, I'm responding, I'm providing my response in an email, but what am I actually reviewing? So this is the scope of what I'm looking at. I'm looking at the calculations as well as the explanatory notes. So if there was other information somewhere, don't worry about it. In this case, there wasn't, but if there was information in addition to these calculations and explanatory notes, focus here. I'm telling you what I want you to look at, so look only at those calculations and explanatory notes. Right? And then very, very key here, the components. We're doing a review, including your current additional questions and information you may require. So that's where I would have done the headings, because for me to remember what I need to do. Very key here that when you're asking the questions or requesting additional information, it's not sufficient to just say, okay, but why did you decide, did you determine the residual value in this manner? That doesn't display an understanding, because I don't know why you're asking the question. So even when you're asking questions, you need to explain to me why. Why are you, what is concerning you? What is the principle that's concerning you? What is the issue you've identified in this question that's making you ask the question? So you're asking me how to determine the residual value, or to say, I'm just curious, I would like to find out how the residual value is determined because explain to me why. As it seems strange that we've used 20% for the different components, right? Explain why the question makes sense. Why should I care about it? Why should I answer this question? Right? So when the person also answers you, they give you the context they're looking for. Otherwise, they'll just give you an answer haphazardly because they actually don't know what the crux of what you're looking for is, what is concerning you. So very key. Even when you provide the questions, give context to it. And when you provide the questions, demonstrate an understanding in the questions. Demonstrate that there's a reason asking this question. It's related to the competence. It's related to my understanding of the principles that are being tested here. So don't ask a blank, open-ended question, right? Even the additional information you're asking for, why are you asking for it? If you're asking that you'd like to see the lease agreement, why? Because there's a lot of information. There's a lot of information included in a lease agreement. The information you're looking for might not even be in the lease agreement. It might be in a different document. So think about it practically. When you're at work and you're asking someone for something, for a document, the audit is a very good example. When you're in audit and you're asking a client for certain stuff, yes, you might provide them a list of things they're looking for, but you're going to explain or at least you explain to make it easier for them to understand. Especially if you're not sure what document you'll be looking for. You're like, look, I'm trying to test this. So I'm looking for this information. I think it's here. Then they'll tell you, it's actually that document doesn't have that. Let me actually give you this. So it's actually to help someone help you. So when you're asking for the lease agreement, explain. I'd like to inspect the lease agreement so I can confirm who has a responsibility to replace the engine at certain intervals, who has a responsibility to perform certain tasks. So explain why you're asking for it and how it's going to help you, how it's going to help me, how it's going to help Serge in this instance. Okay, so very key that you cover all components that we spoke about, review, additional questions, or additional information you may require. So they can conclude on the accounting treatment. And just as important as it is to know what you are required to do, you need to know what not to do. Why? Because if you now go onto a whole tangent on these tax implications, nobody is gonna even look at that page. It is just a huge waste of your time. You're going to feel amazing because you're gonna feel like, yo, I understood this task, I've done such a great job. But the marker will be like, okay, but now what must I do with this? Because I specifically told you to ignore this. You are actually not listening to me. I don't need this information. Somebody else, Serge, has a tax expert who's already told him about that stuff. Or Serge already knows the tax implications. You're telling them something that they don't need. You're wasting your time. You're going to spend, I don't know how long that you could have spent actually answering the question or answering another task. Because that's the trap you fall into. You go on and on and on and on. And then you come back and you get an LC and you don't understand why. Why? Because you did not answer the asked, you answered what you wanted to answer, right? So very key to understand, very, very, very key to understand what you've been asked to do and what you've been asked not to do. Yes, Boni.
So yes, I get that you may ignore tax implications, but what if they then, in the calculation, they give an incorrect tax rate? Is that part of tax implications or it's something else different?
An incorrect tax rate. So to say 28% instead of 27, is that what you mean?
Yes.
I mean, that would be very unlikely to happen. Again, I don't think that's relevant. I think in this case, for instance, the tax element they might have brought in with the impairment was to provide us a post, to tell us that we are going to look at the number after tax. There, the principle was still that you would still address that because the accounting principle is still what's being tested, that your I-36 principle is being applied incorrectly because I-36 and the accounting principle requires that we use a pre-tax rate. So giving you an incorrect tax rate, unlikely when you're not testing your understanding of tax or understanding of deferred tax. It's very, very unlikely. If for some reason they were to give it to you, I honestly would ignore it because it's not relevant. We don't care. You can tell me if you want, but I don't care.
Okay, I'm asking because I'm an ICANN student, and last year we got it like that. So I think I just wrote it, but when I was now doing my reflection, that's when I noted to say, okay, fine, we were told to ignore tax implications, but they gave us an effective tax rate of 27% instead of 32%. Was this even correct for me to note it?
Yeah, yeah. Usually we adjust stuff for that. So if we set a test or an assessment in a South African context, we typically adjust for the correct country, so adjust for ICANN or adjust for ICANN. I think that might have just been a mistake, an error on their part, but that would not have come up as an indicator, I imagine, mainly because it's a tax concern that is not actually what we're testing here. Here we are testing the application of the accounting principles of business context. Um, and we're specifically not testing tax. So if you bring in something on tax, we're probably going to ignore it.
All right, thank you.
Cool. Zama?
Hi, can you hear me? Sorry.
Yes, we can hear you.
Thanks. I just have a question with regarding instances where we are told to ignore a certain discipline. So if we're given in a scenario where they say you may ignore tax implications, but they gave us that instruction in the previous period, are we supposed to ignore it completely when we are researching and applying ourselves then? Or does it ever happen that SAICA like tests a trigger where they said ignore tax in some sort of way? Or is it always to be ignored even in the pre-release and we won't be tested in the IOD?
Okay, I'm not sure I understand, but I think what you're saying is if we are told, I don't worry about something in the PRI, can it come up in the IOD? Is that what you're asking me?
Yes, if that it is, that's what I'm asking.
I have not seen an instance where this has come up. And I think why it should not come up is the PRI is not meant to trick you, it's meant to help you. So when we specifically tell you to ignore something or tell you don't worry about something in the PRI, it should not, I've never seen it come up and it shouldn't. Because the reason we tell you not to ignore something or not to worry about something is because we want to make sure you don't, like for instance, there are some topics that are so broad and we don't want you to spend all your time going into all that detail. So we'll tell you to ignore certain parts of it because we don't want you to waste your time on it. So if we tell you to ignore something, trust us. You don't care. We're not going to ask you in the IUD. If we tell you for leases, don't worry about the tax implications, we won't then get to IOD and ask you about the tax implications because that's a trap. We're not trying to trap you. We are trying to make sure that you only focus your time. So us telling you to ignore or don't worry, I won't want you to look at this, is to tell you, please, please, please focus your time somewhere else. Do not spend your time on this thing that I'm telling you to ignore. So if you say ignore, ignore it. Cool. Khunzi?
So my question is actually the inverse. In one of our case studies during the year, we were asked in the pre-release to consider the accounting and tax implications. And then on the day, they basically ask you for the accounting treatment. And they didn't specifically say ignore tax implications. So they were like, okay, here are a couple of journals. Can you please just like review these? So would I be wrong to bring in those? Because I feel like why would you ask me to do that in my pre-release if then it becomes 100% irrelevant in my IOD or on the day? I hope that makes sense.
That does make sense. And I can't remember which scenario. Was it an internal scenario or a different provider? Because I can't remember
And you know,
can't
it
remember
was
a scenario we
actually
did that.
it was ACC. And they asked us to do the prepare the accounting and income tax, well, the accounting and tax for the provisions and the liabilities and the contingent assets and all of that. And then on the day they gave us accounting journals and basically like the specimen solution and all the marking grids focused so much on the accounting that it sort of felt like they forgot that in the pre-release they asked us to look at the tax as well. And so it's like I wasted time looking at the tax and none of it was relevant, but it feels like it's not relevant. If the CFO last week said to you, look at the tax, and then this week they're like, oh, here are the journals. It feels like to me, I should have a section to say, oh, given last week you said I should look at the tax, here are the possible like tax consequences just for your consideration. I don't know.
Okay. So yeah, that doesn't usually happen. We try really hard to review because typically everything is prepared together. So typically the process finds those kind of things. We've told you to look at something in the PRI and doesn't come with IOD. Typically the process catches that. I'm very sorry that it didn't catch it this time, but please do not do that. If the task then asks you to look at and review certain journals and there's no specific tax concern in those journals, or don't now bring in information which is not relevant to the IOD or the task you've been asked to do. Why? Because again, it's a waste of your time. That's what we see as research dumping, because it's one of those things, and I understand that we feel like I know this, I've studied this, I want to show you that I actually put the time in. But once you doing that is not going to help you pass. It's me knowing that you studied the text, and I'm very sorry that you did, and it didn't come up. But me knowing that you've done that doesn't help me, right? So always remember that when you're sitting in this assessment, you're trying to solve a problem. Like I think, and I usually start with this, so I'll say it here. What we're doing here is we're becoming chartered accountants. What chartered accountants do is solve problems, solve complex business problems, to steer companies in different directions, right? Provide strategic direction. We are problem solvers. So when Surge asks you for certain information and you now give them other stuff that they didn't ask for, you are no longer solving their problem. You're no longer actually helping them. You're now giving them information that they actually no longer require. So please, I beg you, don't bring in research that was not asked for.
Okay, thanks.
Cool. So yes, DN, I don't know what your full name is. The text could be relevant for deferred tax, but it depends what the task is. It depends if the task had a deferred tax component in it, if that was the error, if that was what you're reviewing. If it wasn't, don't bring it in. There was a question in the 8 March where they said ignore tax and was brought as an indicator. And I bet the accuracy of the numbers or when to challenge it. I think that's maybe similar to Petronella. I think that's similar to the example I made now on the impairment. That if you speak to me about tax in general, not overly interested, because I specifically told you not to do it. If you're speaking to me about addressing a principle from IS 36, which says we're only using post or pre-tax cash flows, for instance, we're using a discount rate before tax. You're actually addressing what IS 36 is. That's not a tax implication. You're telling me that I've applied a principle incorrectly here because I've taken out the tax where I should have left the tax in. So I think that was something similar there to say maybe you weren't required to perform tax calculations, but you were actually required to note that the tax had been incorrectly treated here, remove it or include it or whatever happened in that capital budget in question. So it's if there's a specific principle in IS 36 that tells you do this before tax, don't include tax here, that is still relevant. But don't go on a tangent and start doing tax calculations and giving me tax discussions. Tell me if I've done something, I've applied a principle from IS 36 incorrectly. I hope that makes sense. Rachel, I think you're addressing Hunzi's question. Okay, and I think, yeah, people are saying it was asked somewhere else. Thank you, thank you, thank you. Thank you, thank you, thank you. Thank you, thank you, thank you. Cool. Okay, so here, what is the key take out here? When you are actually reading the email giving you instructions, pull out what you're doing. Are you reviewing? Are you discussing? Are you providing journals? Are you providing presentation or disclosure? What are you actually doing? Right? Key to pull out what is the key doing word. Key to identify the different components of the task, the scope of what you need to review, and what you need to ignore. Also key to figure out what the type of communication has been asked of you, and draw on the knowledge from the prior period, being the PRI period. Prints, yes, I always actually, thanks for that. I always recommend an attachment. When you're providing an email, it's just easier because in practice, when you're sending an email to someone, if there's going to be a long discussion, like a review discussion that we're going to have here, I would not put it in the body of the email. I would have an email with a greeting, and then please see the discussion attached and maybe some context that the discussion contains, but I'd have an attachment for the actual discussion. Why? When I provide something like a review to someone, chances are they're also going to engage with it. They're going to review it. They are going to maybe say, oh, okay, and make their own notes onto it. It's easier to do that on a separate document. It's easier to forward that and allow collaboration on this document, allow it to be what should I say, an evolving document. So it's easier for them to also say, oh, okay, this applies to this applies to this, jot down their thoughts, give additional information. So that's in practice. So I would always recommend, even if they don't request an attachment, provide the email and then provide your actual review comments in a separate attachment. Thank you for that. Cool. So now onto the actual document with the actual information. So I said we're going to go through this, which is calculation 1 first. Then we'll go through calculation 3. Remember what we said? We're performing a review task. So the review, what does that mean? Line by line review. What does this mean? Critical thinking, right? Critical thinking is essentially saying, does this information you're giving me align to my prior knowledge? Does it make sense? In the context of my prior knowledge, in the context of what was in the PRI, my prior knowledge in terms of what have I researched about this industry? Is it reasonable given this? Is the information telling me, does it make sense? Is it reasonable? Would I do this? Would anybody do this? Is it technically correct? Right? That's critically thinking. Assessing, do not accept anything in a review task as gospel, because the whole purpose of the task is to test understanding. Right? That's exactly what we're doing. So if you look at this table and you don't see anything wrong here, you're missing something. We cannot give you this much information and it's all correct in a review task, because that is a lot of information. It's a lot of time, right? I think you must also remember, and I don't think I actually know this. So I won't say remember, because people always say to me, stop telling us to remember things I don't know, right? There's a lot of back and forth that goes into putting together a task, mainly because we don't want to waste your time. If I'm asking you to review something, I'm not going to give you this much information. Also, I must come up with all these random numbers. I must come up with all these useful lies. I must do this stuff, guys. So I'm not going to do this to test your understanding of impairment and I-16 and give you nothing to work with here. So in a review task, your critical thinking hat is always on. It's always like, does this make sense? Is this consistent? Why does this feel wrong? What principle is being applied here? What standard or principle am I relying on to assess this? Okay, so always keep that hat on. So before then I activate my animations, what were your guys' key draws or key pickups from this calculation and its note there? Yes, Lot.
Kanye, I think for my side, the concern may be the 20%, which is quite a blanket rate for me. The residual value, I don't think every asset could have the same residual value. And how do you get under the assumptions, reasonabilities, how do you get to this residual value? Maybe market value, or can you resell it, or can you not? Should you scrap it out? So I question the residual value for me.
Thank you. Very, very valid, right? And for you to be able to question that means you've thought about what is a residual value. What is a residual value is basically the amount you can get from for this particular part in its current condition in the future. In the business context, it means in one day, at the end of its useful life, I'm going to sell this part. How much am I going to get for it? What are the chances that I'm going to get 20% across the board for aircraft engines, flight and food service equipment in flight? Does that make it? It's not logical. It seems strange. It seems very generic and doesn't seem like a lot of thought has been applied to it. So very good. That's question the reasonableness. Yes, Rachel.
Thank you. Also, with regards to the actual residual value, I mean, we are leasing the asset. So is it likely that it's not likely that we'll have a residual value because we're not going to get this asset at the end of the lease term. So, I mean, we won't sell an asset that doesn't belong to us. So yeah, that doesn't make sense. That residual value concept.
Love it, right? It's a question, it's a very valid question to say, but I'm leasing this aircraft. How am I going to get residual value? Am I going to get ownership of the aircraft at the end of the lease? It didn't seem to say so in the lease agreement. So if I'm not getting ownership, where am I going to how am I going to get a residual value? Like, where am I going to get this with this amount from? Is there a guaranteed residual value in the lease agreement? I'm not aware of it. So how did this come about? Right? So you're already asking these questions. You are seeing that the unreasonableness. Yeah. So what we've seen here is because the lease, where does the residual value come from? I don't think it's reasonable to have a residual value. Then the question that could come from that to follow to say, well, maybe there is a residual value in the lease agreement. Can I perhaps see it to see whether there is a guaranteed residual value included in the lease agreement, right? So you've picked up the review comment as well as a potential question, and you link the question to why it exists. Why is the question relevant? The question is relevant because I need to understand how we came up with this concept of a residual value in this calculation, right? Another key thing when we speak about integrating standards, and this applies throughout. Integrating standards, integrating disciplines, what you need, and this is what the preparation teaches you. There are certain things that will apply, right? Like depreciable amount, well, not depreciable amount, sorry, like useful life, etc. But there's also certain things that are specific to standards, like residual value exists in PPE. There's a reason you own these assets. It doesn't exist for leases. There's a reason you don't own these assets. So while you're studying these standards, seeing the integrations, you also need to see that, okay, as much as IFRS 16 tells me to use IS 16 for subsequent to measurement, which parts of IS 16 don't fit in the context of a lease? If I have a lease, it doesn't make sense to residual value unless I'm going to take ownership of this asset at the end. So that's the understanding of these standards don't exist in isolation. They exist in context. They exist in the context of the entity. They exist in the context of each other. We borrow from each other, they link to each other, but there'll always be, not always, but there'll generally be some differences, and you need to be very aware of them, right? You need to be very aware of the limitations. Rachel?
Okay. So this is a question, right? I understand that there is no, well, this is what I found when I did the research on this question. I didn't find any specific paragraph in the standards, both IFRS 16 and IAS 16, that specifically say that lessees cannot use the component approach, right? When it comes to assets that are like aircrafts, for instance. However, like we say, it wouldn't make sense for me personally for a lessee to use a component approach in order to calculate depreciation, albeit IAS 16 says when you have components that are significant, that have display different patterns of recovery of economic benefits, then you need to depreciate them separately. But I mean, there's a lot of reasons why it doesn't make sense. Part of it being we don't own the assets, so it's difficult for us to have information. Be that as it may, which information in the pre-release leads me to specifically then go and research about the component approach? Because in the pre-release itself, I would have figured that out to say, okay, it doesn't make sense for me to go that way. And then I would have left it out, which is what I did before my rework. So I want to understand, in case we get to tasks like this in the exam, how do I then make sure that I cover myself? Because I would have concluded in the pre-release that, okay, it doesn't make sense for a lessee to use a component approach. So I don't expect that there would be something like that IOD. So which part of the pre-release would have said, ish, maybe don't do it, maybe study this portion, you know? So yeah, I think that's the only thing that sort of threw me off.
Okay, got it. I'll answer that just now. Lot?
Kanye, so earlier when Rachel asked, you said maybe we may ask the client if they may have the right of ownership. Wouldn't it maybe we get penalized because in the first document you realize the lease about 18 months, which it's not then it then would fall under an operating lease. So definitely they wouldn't get, it's not a finance lease, therefore they wouldn't have the right of ownership in the end. Maybe I'm assuming. So if you start now thinking the fact that ownership, it shows lack of integration of the whole document in itself. Wouldn't that then throw you off from a marker's perspective?
Okay, I'll answer that just now. Okay. Okay, love it. I love this name, Future Say SA. You've noted the number of years used for depreciation. Principal is lesser of lease term and assets used for life. Agreed. Tebiso, if not for the notes, not because I missed most indicators. There's ought to be something wrong.
No.
Yes. As for load shedding. Thanks, Tepiso. Tapelo, there could be an argument that the components are missing major replacement and major maintenance, they're deemed to be the assets that are depreciated separately. Love that, Tapelo, and I'm going to address that now, responding to Rachel's question. Also, depreciation is incorrectly calculated based on the useful life of an asset instead of the lease term. Love it. And then Rulani says, but during the dry lease, which is for 10 years. I'm not sure what you're specifically addressing there, Rulani. Are you saying that it doesn't make sense why we've got 20 and 15 years because of the useful life, which is 10 years? Or that none of these things make sense because of the useful life of 10 years?
No, I was responding to Lot's question. He mentioned that the lease was for 18 months. So that's why I was asking, no, that's the wet lease, but we were currently dealing with the dry lease, which was for 10 years.
Okay, got you. Thank you. Okay, so to answer Rachel first, 100% correct. If you consider leases, 100% correct to think, why would I have components of a lease? Because I'm paying for one item. Why? I probably don't even know what useful life is. It's most likely not my responsibility to replace components if they expire. So probably wouldn't have thought about that, right? However, when we start thinking about maintenance and the way it was described, that you've got the routine maintenance, which is standard, you will expense that. We have the replacement of parts. So that's where that would have triggered you to think of components. Because if you've got certain parts that need to be, we call it maintenance, but you've got certain parts that need to be replaced at certain points in time, that's a component that will be depreciated separately based on the time period between replacements, right? So you would 1.1 need to capitalize it and then remember to treat it as a separate component, depreciate it over its useful life until the next date of replacement. So that's what I think would have triggered that kind of thinking. And you're right that there is no specific paragraph that prohibits it. But again, that's again understanding context, right? It's important to understand the technical, but I think you also need to understand the technical in the context of the question, the context of the entity, in the context of what we are looking at here. So yes, nothing's telling you that you can't apply the componentization, but does it make sense, right? Does it make sense that I'm going to split this stuff out? Do I have the information to split this stuff out? Is it my responsibility to replace this part? Is it the lessor's responsibility? Do I know that? Right? If I don't know it, I've been invited to ask for information to help me know that. Because in the case where, for instance, it is the lessee's responsibility to replace any items that need replacement during the lease period, then it would make sense to know the useful life for these two items, the flight and food service equipment and in-flight entertainment system, because you would need to replace them. You would need to know that in 7 years, I need to replace this item. So if that's your responsibility, you would then need to componentize that. You would need to depreciate it over a lower period. These two being the main aircraft and engines, it can't be. If their useful life is 20 years, my lease term is 10 years, the principal is the lower of the two, unless I'm going to get ownership at the end, which has not been said. To answer your question, Lot, I think someone did answer you already. I think it was Relani to say this dry lease was 10 years, right? But even with the 10 years, it doesn't tell us that we won't get ownership. We don't know. And if you're going to make the assumption that we won't get ownership, tell me why. So if, for instance, it was an 18-month kind of lease, and you were to say, look, the lease is 18 months, so it seems unlikely that ownership would transfer at the end. Tell me that, and then tell me why you're making, like, tell me your assumption you've made and why. So you've told me that it's unlikely we're going to have ownership at the end because it's such a short-dated lease. So therefore, chances are we want to return the airplane to the lessor at the end. We actually don't want long-term lease of this airline. So tell me why you're making an assumption. In this particular question, where you've been invited to ask additional questions or ask for more information, ask the question to say, I see these useful lives extend beyond the lease term. Is this because we are going to obtain ownership of this, of these airplanes at the end? Could you provide me the lease agreement to verify this, to verify these details? So when you make assumptions, explain the assumptions you've made and why you've made those assumptions. If you need more information, tell me the information you need and why you need the information. So I think that makes that I hope that's clear. Ooh. I saw there was a long thing about a lease agreement. Yes. Agreed. So that's what I just spoke about, Rachel, that we'd need to get the lease agreement requested. Yeah. And then Rachel, I won't say we've got the cost for each component you can use. You should componentize. Again, if it's a lease, my responsibility is this lease. If I'm not responsible for replacing anything afterwards, then the components don't matter to me because I actually have a right of use asset. That's all I've got. If it's my responsibility to replace these certain items, then I need to know how long they're going to last because I need to factor into my planning. I need to be ready. I need to depreciate them over the correct term if it's lower, if it's less than the lease term. Because during the lease term, I will need to replace these parts. So therefore, I need to depreciate them separately. So, Gosnati, agreed, right? This is a question. This is exactly the question you need to ask. To say, why would we, even for these two, we don't, unless it's our responsibility to replace them. We wouldn't do this. We wouldn't be worried about the useful life. If it's not a responsibility, we don't care. It is the lessor's responsibility. They'll figure it out. They need to worry about the components. They need to make a plan. And we carry on replacing this or dealing with this as one asset, which is the right of use asset, because it's one thing. That's our only responsibility here. How do they get to cost figures? I imagine. I mean, it's a good question. How they got the cost of different components? Because what we would, and that's a very good question to ask. Like, how do we determine the cost for each component? Because these are leases. For a lease, we only have the value of the right of use asset. So unless somehow the lease agreement gave you a different leasing amount for each component, it's very unlikely. You can, well, it's very hard to determine how you'd come up with this number because that's exactly also why it's difficult to do this or shouldn't do this, right? So very good question. Ask this, but ask with the context. How do you determine the cost of the figures? Why do I think it's difficult for me to determine the cost? Because my lease contract would have given me one figure, or a few figures for the lease payment over the useful life, any initial direct cost I might have had, any provisions for not restructuring, replacement or disposal at the end that I need to consider in determining the right of use asset. It's unlikely there would have been enough information in the lease agreement to enable me to perform this calculation. So ask the question as to how they did this and explain why you're asking it. Exactly what you're saying. Cool. I think we've actually covered a lot of what I was saying here. All right. So what is this little figure meaning? It just means this depreciation on leased aircraft is when IFRS 16 meets IAS 16. All right. Because what does IFRS 16 tells us to use IAS 16. And so the points we've just made now, which is going to pop up, that remember which principles of IAS 16 can be applied to leases and which ones cannot, such as residual value. So this is the integration. We need the integrated thinking to come into play. We need integrated thinking in the context. We need critical thinking, right? We need to remember what makes sense and what does not. Okay, patience? Patience, I can't hear you if you're speaking.
Okay, good evening. Can you hear me?
Yes, good evening. I can hear you now.
Thank you. So this evening, one of my key takeaways was comparing information in the PRI and information on the day. So on this one, I've just checked in the PRI on the depreciation amount. I see there is a very big variation from the one that is on the PRI and the one that's given on the IOD. So I would definitely question what has happened that has made this big variation. I would question the variation actually, whether the forecast is reliable or the assumptions that were made when preparing the forecast. What assumptions were made actually, and why has it differed greatly with the one on the IOD?
Valid. And that's one of the things as well with the maintenance cost. It was like, this is a very big variation. What has caused it? Who is inaccurate? So that's a question. What's wrong? Is it the forecast that's wrong? Is it the calculation that Greg and Rashid Consulting or GRC have performed? Something is inconsistent here. Are we not comparing apples with apples? What has changed? So key to note, especially if we're looking at a task like this, where we've got information and that bring us new information which doesn't tie in. Tsepo? Tsepo? I can't hear you speaking.
Can you hear me?
Yes, I can.
Okay. I actually have the same question as the previous speaker. That were given on the day to the PRI. So the carrying amount of these 4 aircraft, when compared to the information on the statement of financial position, it's already like way above the carrying amount that is reflected there on the PRI. So would I pick that up as an issue and question that as well, or would I be reaching?
Where are you seeing this carrying amount?
So what I did on the information on the day, I added all the costs for all the components and deducted the depreciation, and I'm getting like a 644, 616. And then when I go to the KRI on the right of use, getting like 470 something, 79.
Okay. Okay, let me caution that yes, definitely you need to assess if the information you're looking at in the IOD aligns with what's in the PRI. I'm not saying spend a lot of time doing that. I'm not saying focus on that comparison. Yes, do it. Make sure it's reasonable. Make sure things aren't swinging out of control, but don't spend too much time doing that because that might be one indicator, whereas there's a lot more that's going wrong here. Another thing with this particular thing. So agreed, you say cost, less depreciation, but this is most likely an annual depreciation. It's most likely just for 1 year, where the carrying amount you're looking at in the Fs is after depreciation of a few years. So that's also something to consider, that it might not just be 1 year's worth of depreciation. It didn't say accumulated here, so it might not, these figures here might not be accumulated depreciation. So be mindful of that as well when you perform your comparisons. Does that help, Tsepo?
Yes, it does help.
Thank you. James? After James, I am moving on from this. James? Okay, James, you don't want to be the last one. Okay, it's fine. We still have a whole impairment to unpack. So so the key things I wanted to highlight here was IFRS 16 meeting IAS 16. How do they integrate? What are the things that are in IAS 16 that aren't applicable, that can't be applicable to a lease? We've discussed this, like residual value. Looking, and this is to try to also express the line by line thinking. I'm looking at the heading and I'm really thinking IFRS 16 and IAS 16. Looking at these headings, I should have added a bubble for this, but when I think of the cost, I'm thinking this would have been the original right of use. So it would have been lease liability plus any initial direct costs, plus any provisions for restoration, etc., etc. What is the depreciable amount? It's a cost less residual value. And then that brings the question we asked, can I a residual value on leases? Is that reasonable? Right? So that's where the thinking is going already. Right? So this question we're asking, we are already going to ask it, why would we have a residual value on leases? Does that make sense? Then they come back here and tell us about the fact that the residual value is 20%. Like, okay, one, I don't think it makes sense to a residual value on leases. Two, even if we did, it doesn't make sense why we'd have a 20% blanket percentage across all the different components you're showing me here. So how have we determined this? And we're asking those questions, right? Still looking at just the headings, looking at the life. We already said this, the principle is it cannot exceed the lease term. So it needs to be the principle is the lower of the lease term or useful life, unless you're going to obtain ownership. Nothing has indicated that in this case, so we don't believe that to be the case. And then to your point, Tsepo, is the depreciation reasonable? Does it agree? Is it consistent with the information I've seen previously? If I look at the depreciation on statement of profit and loss, is this amount reasonable? When I look at the maintenance cost, which I'm not going to discuss, but in calculation too, are they consistent with what I'm seeing in the PRI? Does it make sense? Okay. And you guys asked us, how did we do this? How do we perform the split? Where do we get these numbers? I told myself as I read the headings already, I knew that we cannot exceed 10 years because that's the lease term. So I'm highlighting a problem here. How do we end up with 20 and 15 years? Why would we use this? It's against the principle. So we're going to raise a comment on that. These ones, we are wondering, do we own them? Who is supposed, no, sorry, not do we own them? Who is supposed to replace them? Is it our responsibility or the lessor's responsibility? All right. So the key part of this slide really is to see how we've unpacked line by line. We've gone and looked. Do I agree? What should I be thinking about here? What is wrong? What am I questioning? And if you just look at the number of pop-ups on the slide, you see how many questions we could have asked. We already could have earned the indicator on asking about, of questioning the applicability of a residual value on leased items. We could have earned the indicator on the reasonableness of a blanket 20% residual value. Both of these, this is not something that IFRS is going to tell you. IAS 16 is not going to tell you this, right? IFRS 16 is not going to tell you this. This comes from understanding, right? It comes from reading what the standard says, but applying it to the information provided to you on the day. Understanding the area in which the business works, understanding understanding the term of a residual value, understanding in which circumstances it can apply, and when it will not. It doesn't make sense to have one. So this is where the business context is to come in. This is where you have to apply thinking outside just what the standard tells you. You need to understand the principle and the standard, but then make it your own and think about it as a problem solver, as a chartered accountant, right? And I think that's the last thing on the slide. Yeah. Lot.
Sorry to back check you here. So just for learning purposes, right? For instance, in terms of IFRS 16, one of the indicators of finance leases, if you use it for the major part of its economic life, right? So now, because of componentization, now how do you then determine if it's being used for the most part of this economic life? Because do you go for the highest asset component, like the 20 years? Or now how then do you determine the indicators of a finance lease? Because sometimes it doesn't need to be explicit, but there can be indicators that based on the use, then it then is a finance lease.
Okay. So step one is to remember that in this case, we are a lessee. And a lessee does not differentiate between operating a finance lease. We only have a right of use asset, always, right? So from a lessee's point of view, we will always have a right of use asset. So we'll always bring an asset onto the balance sheet and a liability onto the balance sheet. So this classification is irrelevant for this particular task. From the side of the lessor, which is why I think a very key consideration here is it's unlikely in any circumstance that a lease agreement would give you enough information to do this, right? I am not leasing out an engine and a food service equipment, and I am leasing out a plane. So it is the plane that I'm assessing who has the ultimate risk and rewards of ownership. And that's why this componentization is not making sense in the context of a lease for the most part. Yes, sure, if the lessee needs to replace parts of it, those parts are not a standalone asset. They could not be leased separately, right? So I wouldn't apply a lease to them separately. So the standard could not be applied to them separately, meaning that the classification considerations also cannot be applied to these separate components, even if we could determine them in a lease, because they can't be used separately. There's a question. Oh, Rachel, yes, that is a very good comment. I don't know why I don't have it here, but agreed. You need to consider what is actually the most appropriate depreciation method for the different, if we're going to componentize, what is actually the most appropriate method, for instance, for an engine? Even for the maintenance, like the replacement parts, we are told that one of the replaced parts or parts you have to replace on a regular basis, which is our responsibility, needs to be replaced after a certain number of flight hours. So for that particular component, we would then depreciate it over the flight hours. Then we're saying, is it taking it too far to question the restoration of the planes, based on the fact that they have branding, which might need to be removed when the aircrafts are returned? My question is, what do you mean questioning? Questioning it on what basis? Questioning it where in this task? At which part of this task? And the cost? So are you thinking of restoration as a separate component? Because restoration, if there is restoration, again, it would be on the right of use asset as a whole. So, Ntabi saying, componentization, generally, it's not applicable for an ROE asset. It doesn't make sense to componentize an ROE asset. Why do you want to have the information? Two, you've only rented the right of use asset. An exception exists. So general principle, we should not have components to an ROE asset. An exception exists if we are responsible to replace certain parts, and those parts are going to need replacement during our lease term. Because in that point of view, we probably have the information to determine the cost, and that useful life is appropriately lower than our lease term. So generally, no, it doesn't make sense. We are releasing a solid asset. You only have one cost, you only have one asset, which is the ROU asset. In the rare circumstance where we are actually responsible for replacement of, I don't know, flight and food service equipment, then it could make sense. But it's very rare because that's not how things typically work in business.
Sorry,
Yes,
can you
James?
just to quickly, sorry, I was struggling with my mic. Just to quickly jump in on that comment. I was a bit confused there when you were just also, assessing on the residual values, because I think maybe my assumption could have been incorrect to say, on the pre-release, you were told that, this is a dry list. So practically when you have to review this now, you have to look at it from an angle of saying these flights and food services equipment and the flight entertainment systems, they are probably costs that we capitalized or maybe incurred in order for them to exist, for lack of a better word, because now it's a dry list. So you just only get the plane and the what you call the engine. So I wanted to know now, when you have to now review the residual value, would it then come from an approach of saying no, from the pre-release it was say there is an existing market for you now, when you have to, at the end of the lease, you might have to dismantle these things and sell them on a second-hand market. So I think that the way I questioned it, the residual value was coming from that approach. But the way you are discussing it now, I don't know, maybe it was just a matter of now having to also apply whether does the lessee or the lessor have to replace these items, because now it's still a dry lease, but then there could be a concept of saying no, but the lessor is still responsible in a contract to replace them. So that's where my confusion from the pre-release and coming to also integrate it to what you are saying on the IOD. Thank you.
Okay. So these components are part of the aircraft, right? So the dry lease means that they give us the aircraft, and then we worry about insurance and maintenance and all those wonderful things. Unless I missed it somewhere, and maybe I did, they did not say that these are separate. These were obtained separately or acquired separately, like the aircraft and the engines. These are parts of the aircraft. So when we receive the aircraft, we would have received all of these, right? So I can understand the confusion from a componentization point of view to say, why would we componentize it? Why would we consider componentization here? And that would only be appropriate if it's our responsibility to replace them, and that we don't know. So that's one of the additional questions we're going to ask, to say, why do we have this? I see the useful life is less than the lease term. Or is it our responsibility to replace it, or is it the lessor's responsibility? Can I see the lease agreement? Because maybe in that case, componentization will make sense if it's our responsibility. But if it's not our responsibility, these two should not be a separate component either, because they are part of the aircraft. So their cost is included in the overall cost of the ROU asset that has been provided. From a residual value point of view, the consideration is whether will I get ownership of these things? So will I be able to sell these subsequently? It's all good and well, there's a market for them. There's also a market for the entire aircraft, most likely. But at the end of the day, if these things are attached to the aircraft and I don't get ownership of these particular components of the aircraft at the end of the lease term, I still cannot sell them in this market that exists for them. So then the residual value is of little relevance to me as OTA. Does that help you? Does that answer you?
No, most certainly. No, thank you so much. It makes sense.
Thank you. Noguzanga and Khonsi, I see you're saying has it been included in the ROU asset. I'm just struggling to say, or I guess maybe the question I'm asking back to you guys is, remember our task is to review the calculation performed. So when we are asking, has it been included in the ROU asset, are we expecting to see it as a separate component, or how are we expecting to see it come across in this task? So for us to ask the question, how would we have expected to see it? So how would you phrase the question to say, have you included the restoration cost? Where? What would the full question be?
So, for me, you've already given these components, so there's already an expectation of what exactly goes into this rights of use asset. So much so that you've even stipulated cost, which isn't information that we're privy to. So I would expect, given that we know that we're gonna have to rebrand these at a future date, that we would present value this, we'd have this amount and it would at least be considered as a part of our depreciation. So that is how I would sort of phrase that.
Okay. Okay. I think the fundamental principle here is that with an ROU asset, this is not right, right? Typically, you should not be componentization. We have the right of use asset based on essentially the lease liability plus all these other things talking about the restoration. So we actually shouldn't be seeing any of it separately unless something funny is happening. The restoration would not be a separate component. It would not be depreciated separately. If, I mean, we don't know how they determine this cost, but it would be, you're right, it would be added to right of use asset on day one, but I would not expect to see it separately here because it would be depreciated also similar over the lease term. I would not expect to see it as a separate component because it's not something in addition to, it's not a separate part. It's something that's part of the right of use asset. So first, and what we need to understand is I don't expect to see this for ROE asset because it doesn't make sense. And the question about whether we're going to replace these, right, is to try to make sense of this, to try to make sense of, I can maybe understand why we've got components here if we need to replace them. But let me see the disagreement to say that. And then that's why we've got these costs. That's why we've got these costs because this is the cost we're going to replace. This is the cost we're going to depreciate over this useful life. And at the end of this useful life, we'll then bring in the new flight and food service equipment.
So then just a follow-up question on that, would it not change based on who has the responsibility to brand?
That's it. On who's the responsibility to brand? Brand would not be a separate component. So are you saying would these things change? I think the branding or whatever would be included, I'm assuming, in this cost here, if we're going to say componentization is right. But very key to emphasize,
Okay, makes sense.
componentization is not right, but it would probably be included in one of these because it would not be a separate component.
Okay.
What is the structure of the questioning? Must I explain why I'm asking and what conclusion it will bring? When I say the structure of the question, I need you to explain. You're asking a question. So for instance, you're asking, how do we determine the residual value? Explain the context of as to why you're asking this, right? So yes, explain why. How do you determine the residual value? Why am I asking? It seems strange that a blanket 20% would have been applied to all components because it is unlikely that the price the price to sell in the market will be the same consistently, kind of thing. So bring in the reason you need to bring in the why is to demonstrate the technical principle that's concerning you, or the business thinking or the business context that's concerning you. So asking the question just to say what determines the residual value doesn't give me insight into your thoughts. So I can't award you an indicator for that because I don't know why you're asking it, right? Very key part of APC in general is, remember, it's called the assessment of professional competence. So the onus is on you to demonstrate your competence. So if you've got information here, right, there's a reason you're asking this question. You're asking it because it doesn't make sense to you. If you don't tell me and put it onto the paper, what is concerning you? I don't know that you know. I don't know that you understand the principle. I don't know that you understand what a residual value is. I don't know that you understand that this doesn't make sense or why it doesn't make sense. So I can't award an indicator if I need to guess why you're asking the question. So that's why your question needs to be have the why and explain why we're doing certain things. Okay, cool.
Just quick one.
We really need to move on from this one, guys. Impairment is big. James?
No, it's clear. No, I was saying, knowing that, the right of use wouldn't, practically have a residual value. So that's why I was saying it was a bit tricky now, to say, the 20% would only be featured probably in the flight and food and the other, because the other ones, that it's a right of use asset. So the residual value wouldn't be appropriately applied there. So I think that's where my confusion was, just to understand the application of it. Thanks.
So I guess what you're saying is you'd have gotten this indicator to question the applicability of residual value in a lease, given that we don't own, that we don't obtain ownership. But you probably wouldn't have gone and questioned this because you already determined that it's irrelevant here. What you're saying?
Yes, sure.
Okay, and I get that. I mean, I understand that. A lot of people could possibly do that. You will still lose this indicator because that's what the line-by-line review does, right? When you're doing a line-by-line review, you're questioning every single line that's provided to you here. You've already questioned, why would I have a depreciable amount? That doesn't make sense. What is a depreciable amount? It's cost less residual value. Doesn't make sense with a residual value. You're like, okay, guys, but the concept of a residual value, the way you're applying it, already doesn't make sense. So that's the thing about a line-by-line review. You don't stop somewhere. But I also don't think if you missed this alone, it would have cost you an overall competent response. Because I can see how you'd have missed it, and that's why you've got like a lot of indicators, and you only need to get half of them, well, just over half, to actually be competent. But I understand your reasoning that I've already concluded that doesn't make sense. Why am I expanding on that? Fully get it. Just caution, line by line. If the line doesn't make sense, if it's going against the principle, flash, flash, flash. Okay, so this is there in the this is the reflection feedback video. Lots of animations, but this is the one that I want us to actually unpack. Okay, so C3 was on impairment. And impairment, if you remember, I said was that wide trigger that speaks about indicators, speaks about what is a CGU, identifying a CGU, is it appropriate, are the correct assets included in a CGU? What is a recoverable amount? What are the principles for determining value in use? Do we use pre-tax, post-tax cash flows? Which discount rate should we be using? What cash flows should we be using? So those are all the wonderful things that are going to come into play here. So let's throw it. Let's go. What are we seeing that is wrong or weird here that we should be questioning? If I am reviewing someone else's work and I look at this, and this is what they're saying about impairment of aircraft number 3, what feels funny? Think IFRS, think think IS-36, think widely IS-36, think reasonableness of understanding the context, the lease, yes, the lease, the business context, what do I know about this entity? Yeah, okay. Yes, Tebo, inclusion of IFRS 9 items, and Blessing speaks to that, inclusion of trade and other receivables. Yes. Why is that strange? Because remember, when we are including assets in a CGU, it needs to be assets that can be reasonably and sustainably or continuously allocated to that CGU. Not clear and supportably allocated to the CGU. Trade and other receivables aren't necessarily attached to one CGU. Cash and cash equivalents also, they're just kind of, they probably come from multiple different stuff happening from different aircraft and all that wonderful stuff. So very key consideration there. IS-36, receivables out of scope for IS-36 should not be included. Cash, okay. All very good points. I want to pause a bit on that principle, on the scoping, of IS-36, right? So IS-36 scope has specific items which do not apply the measurement requirements of the standard, right? Stuff like inventory, which will be impaired in its own standard because IS2 requires to determine the law of cost and realizable value. So it's dealt with. The amount of the financial statements for inventory already covers that. IFRS 9, we've got the ECL, we've already covered that. A few other items also completely excluded, right? However, if it was possible to allocate inventory, I mean, not in this context of an airline, because we typically wouldn't have inventory here, but in a context of another entity, like a manufacturing entity, and it's possible to allocate the inventory to that CGU. This is I want us to understand this. When we are determining impairment, we first determine all these assets that should be included in the CGU, assume the inventory or whatever should be here, right? If it's part of the CGU, it is allocated to the CGU, it is part of making the cash flows of that CGU, it is included in determining the total carrying amount of the CGU. So in step 1 of the CGU, where you're determining the carrying amount, you will include those items that are not in the measurement scope of I-36. Okay? You will include them in determining the total carrying amount. However, when you allocate impairment, you cannot allocate impairment to inventory. Why? Because you cannot affect the measurement of inventory through I-36 because it's outside the measurement scope of I-36. So it affects the total carrying amount of the CGU because what's a CGU? It's the smallest group of assets which generate cash flows together. So the inventory affects our cash flows, our ability to generate those cash flows, including that inventory in the CGU, demonstrates the value of the CGU. If we leave them in determining this point of view, we're going to undervalue our CGU. So in our CGU, bring together all the assets, all the assets that come together, the smallest identifiable group of assets that generate cash flows independently, right? We bring everything together. But if the CGU is impaired after all of this wonderful stuff, we do not allocate impairment to assets that are outside the scope of I-36 for measurement purposes. Inventory, financial assets, there's a whole list. We do not allocate impairment there. Okay? Rachel, question, should we not have lease liabilities? What does I-36 say about bringing liabilities into the CG? Teams is lying. They said I can talk until 9. They said my hard stop is 9. So I'm running with it. Rachel, what is the principle? What does it say about liabilities?
So my understanding is that when we calculate in the carrying amount of the CG, we don't include liabilities, right? Unless we cannot determine the recoverable amount without considering such a liability, right? So, I mean, we could argue that that carrying amount needs to be included. I mean, the lease liability needs to be, because this is a lease, because of the whole thing of it being a lease and a right of use and all of that. So that's why I was asking, should we not include for the carrying amount?
100%. It's a very valid consideration, and it's correct that, and you've stated the principle exactly correctly. That the principle is we typically don't include liabilities here because we need to avoid double counting, etc., unless we can't determine the recovered amount of the CGU without those liabilities. In this case, we could never sell the ROU, the aircraft, for instance, or get the value from the right of use aircraft, because actually we can't sell the aircraft, but we could never get the right of use asset. We can never get the value from the right of use asset without the lease liability. So these two actually go hand in hand. So it can be argued in this case that we should be including the lease liabilities in this CGU. And that is something that was covered that was actually included, that we would have been an indicator for. So yes, in this case, it can be. And again, that's exactly it, right? Applying the theory to the situation. It says, don't include liabilities unless it doesn't make sense to exclude them. And in this case, we can't determine the value of the CGU without them. So that's understanding what we're dealing with. We're dealing with the lease. So there's certain exceptions that Tanasha?
Hi, how are you? Good evening.
Good evening. I'm well, thanks. And yourself?
Great. So just a quick one. My question relates to a corporate asset. I thought I read somewhere, I don't know if it's in the reflection deck or in the slides that you was talking about even to being a corporate asset. I don't know if you can maybe just refresh me on that one, because I think what's catchy about the corporate asset in the CGU?
Okay, got you. So the corporate asset is one of the examples they provide to us of assets that, so a corporate asset, an example would be like a head office building. Head office building typically does not actually earn any cash flows. It is just a building there, it's just a cost center, right? But it exists to ensure the benefit of the business as a whole or certain CGUs. So with that, there is a way to allocate on a reasonable and supportable basis the cost of that corporate asset or the value of that corporate asset to specific CGUs. Most likely it won't come to one CGU, it will be allocated across multiple CGUs. So in that case, it's one of those things where you can say, yes, there is a reasonable and supportable basis to bring that into the CGU. That's really the key of that.
Okay, thank you. I don't know why I thought inventory can be corporate asset. I don't know for some reason.
No, inventory is not a corporate asset. It's typically head office kind of stuff.
Okay, cool. Thank you.
Okay. So we then looking at what doesn't make sense, right? What have we said already? We need to see if things are consistent with our prior understanding. They are telling us that each of on times 4 aircraft flies a specific configuration of routes and flight times and is essentially a separate operation within the bigger company. In that, when I read that sentence, does that sound like something I know? Because when I read the background information, the PRI, they told me that we've got 4 aircraft and we've got specific routes and all of them fly on these routes. So does it sound right that aircraft 3 is seen as a separate operation on its own within the bigger company? Because they all kind of do the similar thing. So why are we saying that? Why are we saying this? Right? We're then going first to say each aircraft is a cash generating unit as defined in I-36. So what they're saying is each aircraft essentially is a small identifiable unit that can bring in cash flows by itself. Again, does that sound right? Right? So when you read this, you're like, okay, what is a CG? And what the definition is. Does that sound right? Because can each aircraft operate separately? Do they need each other to supplement the different routes that they're flying? Does it make sense in the context of this industry? Is there a different way that we should be allocating this? Is each route a CG? Am I thinking about this correctly? Because don't they supplement each other? If I only had this one aircraft and it was only aircraft 3, and I've got all these routes, would it be able to fly this route? Does it only fly on one route? Are the routes different amongst the different aircrafts? We actually don't know. Do they not supplement each other? Say, okay, I'm going to Durban, don't they work together? Right? So this is the question. Say, from my understanding, we've got very few routes and all these aircrafts actually fly on these routes. Why are we saying even a separate CGU? Because most likely the reason we've got different aircrafts and they're all flying on these limited routes is to ensure that we've got the capacity to fly on these routes. So can they generate independent cash flows? Most likely not. So question that. Question the basis of the CGU determination, right? Again, if we've considered whether there are any indicators of impairments on each aircraft and found the economic performance of the third Airbus is within expected. Question that. Why is it different? Why would, if all these aircraft are flying very similar routes, they're flying on the same routes, why would aircraft 3 be the only one that's impaired? What test did they perform to the other aircraft? Right? Have they considered the other aircraft? Exactly. Why is only one airplane impaired when all of them are flying the exact same route? Does this make sense? Is it consistent with my understanding of the business? They've told, and this is where you bring in the PRI to the IOD. They told me certain things in the PRI. I know how this industry operates. I know the limitations. I know we've got certain routes. This doesn't sound right. So you're bringing in the PRI, the IOD, and your understanding of what a CGU is. Your understanding of smallest identifiable unit, your understanding of impairment. If aircraft 3 is performing less than expected, that indicates that maybe there's lack of demand on certain routes. Why would only affect aircraft 3? Aren't the other aircraft also flying on that same route? Why aren't they affected by this performance? So yeah, so that's part of the thinking on just that little paragraph here, and bring in CGUs. Pile?
Hi, Kanye.
Hi, how are you?
I'm great, thanks. How are you?
Good, thanks.
All right, cool. Maybe, yeah, no, I see that I might have understood this concept wrong. You know how I looked at the possibility of agreeing with the notion that the each aircraft can be a CGU on its own. So I looked at it from the perspective of the components of the aircraft being assets, and these assets being unable to generate cash flows independently. And each aircraft, us being able to attribute cash flows generated by each aircraft. So I did not link the aircraft and the route as you guys are right now. I just looked at it as we have components of the aircraft being the engine, the body, and stuff like that. And these assets cannot generate cash flows independently. And the revenue from the ticket sales from each aircraft we can actually attribute to each airline. So that's how I looked at it.
Okay, got you. First, remember the components. Even when you componentize items of PPE, we aren't actually saying these things operate separately, right? We still have actually the asset is the airplane. These other things have different useful lives. They need to be replaced at separate intervals, but the actual thing is the airplane, right? Then that is in other instances, might have been correct. That's where the business context comes into play. In other contexts, in other backgrounds, in other entities, it might very be correct that one aircraft is a CGU. Maybe if they all fly different routes, so they don't need each other, they don't balance each other out. So that's the thinking of it in the context of this situation. Why would they need to fly together or fly the same routes if they aren't actually working together? If I've only got one aircraft and I'm only flying one route, sure. If I've got two and they fly two completely different routes, they obviously have no interdependencies. So they don't need each other. So then I wouldn't expect that thinking process to come through. So that's really the interrogation you need to apply to the information provided to you. Also, I think a lot of people, probably because when I did the script review earlier, a lot of people did not actually question anything in this block. And I'll say again, this is a review task. It cannot be that I've given you this much information. It's all correct. There's nothing questionable. There's no question you should be asking. There's there's nothing that feels, read it again. If you're reading a whole note, a whole explanatory note in a review task, and you're not worried about anything, pause and reread it because it cannot be. It cannot be. Okay. So in this particular slide, I used different colors. I hope I was consistent for different purposes. The blue is to bring in the principle. The green is to bring in the additional thinking to say integrate to the PRI IOD, integrate to my understanding of the business. So thinking, yes, this is the great theory, but how do I then bring it into what I know, the information I've been given? Okay, so that's the CGUs. We are not, so Nombuso and Tlanipilo, we are not saying they're different CGUs, right? We are saying it's unlikely they're different CGUs because they all fly pretty much the same route. So their cash flows are probably dependent. They aren't independent cash flows. The cash flows are dependent, right? A CGU is a small identifiable group of assets that generates cash flows that are largely independent. So because these cash flows are dependent on each other, it's unlikely that they'd make a CGU. Maybe all four of them together would be a CGU. That's really what we're saying. Lot, can I not ask you a question? Let's go through the actual detail on here. And if we have time, because I am cognizant that my 9 o'clock deadline is approaching, then we can go into questions, right? Cool. So then, again, going on to the line by line review. All right, we've reviewed this line by line. We've asked ourselves questions. Now we come onto here. And this is where you guys already started talking about which assets we should not be including. Right of use asset makes sense, right? It makes sense to include it in a CGU. It could be an asset. It would probably be part of the cash flows. We could identify an ROU that could be part of a CGU. We could allocate it. Vehicles, furniture, and equipment. Possibly, possibly not, right? So there's sort of a question mark here. If I would ask the question, because are these vehicles only used for this particular aircraft? So are they specific vehicles that we say will only transport? If you think of an airport, and this was something that I experienced, I think, on like the second or third time I went there, that sometimes when in the airport, you don't just walk straight in, like you don't walk into this path that leads into the plane. Sometimes there's like a random bus that then transports you to the airport, to the actual plane. It's still very random to me. But the question I would ask then is, are we trying to say that there's a specific bus that is only used for this aircraft? That doesn't make sense to me. Do we not use multiple bus or the same bus for multiple airlines, right? So let's ask the question, how are we allocating these vehicles to these particular CGU? Is it not used for any other? No, guys, APC consumer. It just needs you to not only apply what's in the standard, apply the standard in the context. Take a step back and think about what's going on, right? The leasehold improvements, I can see it. If we're doing something to the aircraft, I don't know what we'd be doing, but if we're doing something to this aircraft, it would be allocated to this aircraft. I can see how it could be allocated to the CGU on a reasonable and supportable basis. It makes sense. Pay other receivables, cash and cash equivalents. That's the question. How have we allocated these items to the CGU? Are they allocatable? So let's ask the question. Does it make sense to say that these assets should be here? Can they be allocated to this particular CGU? Are they not actually broader? Like the vehicles I just said, are they not used for multiple things? Are the trade and other receivables not used across multiple, are they not contained of amounts that come from multiple CGUs, right? And then that's how they come to the total carrying amount, right? Then they come now and say average projected cash profits per annum. Why are we now using an average? Like, how did what's going on here? What does IS 36 tell us to use? It says we need to determine the inflows and expected inflows and outflows, right? For a forecasted period. And then we're going to extrapolate. Where is this average coming from? Have we extrapolated? Why would this amount stay constant throughout the period we're going to use for determine the value in use? I'm looking at this, I'm just like, no, guys, this is not how you perform the calculation, right? So this is where we also come to integration, but not integration with math, because this is very similar to performing a discounted cash flow, but only with the rules of I-36, because I-36 will tell you to exclude restructuring costs, exclude future improvement costs, exclude this, which math might not have told you to do from a discounted cash flow point of view. But essentially, we're bringing inflows, we're bringing outflows, we're doing it over a certain period. I-36 typically says 5 years is the most supportable. Maybe we're doing it over 5 years. We're extrapolating like we would with the normal discounted cash flow. We're using a specific discount rate. We're getting a PV. Why do we now have just one amount? How reasonable is it that my cash profit would stay, even my average, like it just doesn't make sense. Why are we using an average? Why am I using a constant one? Why am I not doing individual amounts year on year? All right? So I'm questioning this. Suddenly, the residual value is not applicable. Why did they only realize this now? So here, I agree with them. There is no residual value applicable on a lease. I would then question here that, okay, but you're not being consistent, because when we looked initially at calculation 1, you brought in residual values on a leased asset. Why have you now determined that it should not be applied here? I agree with you in this instance, but then remove them from there as for my previous comment, right? You're not being consistent. Integrating even within the task. Keep present of what I've seen before and how if it still makes sense. Okay? Then we're using the prime interest rate. No. What does IS 36 say? IS 36 says the discount rate should reflect asset-specific risks. It should take into account time value of money, yes, but it must also take into account asset-specific risks. So I'm going to question that and say, no, guys, prime doesn't take that into account. We need to use a different rate that brings into account the risk of this particular asset or this particular CGU. And then again, I mentioned the point of extrapolation. We've just gone and used one amount for 5 years. I don't even know. We don't know actually what's going on here, right? We have not extrapolated. We have not applied the method for calculation that we have determined here, right? This is actually supposed to be pointing here. The discount rate here, we're using prime after tax. IS 36 tells us we should be using a pre-tax rate. So we're telling you this is an incorrect application of principle. And this is the point I was making earlier, that we said ignore tax implications. But here we were seeing that doing something wrong with tax. It's not a tax implication. This is the incorrect application of an IS 36 principle. So here I need to bring this in. I am pointing it out. I'm seeing it. You're applying IS 36 incorrectly. So bring this in. 10 years. So we are going to PV this over 10 years. IS 36 cautions against going beyond 5 years because they think it's very unlikely that you'll be able to get a good estimate or reliable estimate over a 5-year period, right? So that's what IS 36 is. That's the principle, right? Additional consideration here is, even if IS 36 didn't say that, why would it do 10 years? This lease, all the leases are for a period of 10 years. None of them started now. So on what basis? None of them started today. So on what basis would I use 10 years? Because that 10 years exceeds the remaining period of my lease term. So it can't, even if IS 36 did not say 5 years makes sense, and that's the period at which a reliable estimate can be made, 10 years is just too long. My lease has already gone. Some of them are probably 2 years in, others might be 3 years in. 10 years is just too long, considering both IS 36 as well as the business context. So even if this here is very key, because if you had argued either of, you'd have got the indicator here. Because you're thinking in the context. This you're applying the principle. Either way, you're looking at this, you're critically assessing it and realizing it's wrong. There are two bases on which it's wrong, and either one that you argue would have gotten you an indicator here. Right? And then here, as I said earlier on, that one of the most simple concepts, it seems so basic, probably most of us missed it, is what is the recoverable amount? The recoverable amount is the higher of value in use or fair value less cost to sell. There is no fair value less cost to sell absolutely anywhere here. So how are we okay? Let's just determine that there's an impairment loss. Why have we not determined fair value less cost to sell? We need to indicate that is missing in the methodology. All right. So before I do the last thing here was, are we missing anything? And that goes to a point made earlier, I think it was by Rachel, of the lease liabilities. A review task, we said, is assessing technical application, all these blue things, assessing reasonableness, assessing things that are inconsistent with our understanding, and looking for omissions. So in this part here, we have covered pretty much all of that. Oh, and very key, the line-by-line review. Do you see that if I had just jumped to the things that jumped out at me, and I just looked at impairment losses, this, I'm not even questioning this. If I just looked at the things that I know without doing a line by line, I have missed so much. All right, I have missed so much. I'm not going to get coverage. Whereas if I go line by line and assess it against, is it consistent? Does it make sense? Should it be here? I actually have some meat to my review task. Can you see how rich just this page is of indicators? Yeah, I want you guys have been talking in the comments, hey? Like, I actually can't. I'm gonna miss so much. So I'm gonna start here. Yeah, so you spoke about, I think I spoke about this as well, about the remaining portion is 7 years. So why not 7 years? Agreed. 5 is a reliable estimate. Agreed. So both things here on the period we should be using. Then there's 5, unless you can provide reliable estimate and judgment approved by management. Exactly, right? 5 years, according to I-36, makes sense. Because that is the period that it's more likely that your estimate is actually reliable. Doesn't the standard say we can work without fair value, less cost to sell if we do not have it? Agreed. So standard says two things. I was actually confirm, but I do believe the standard says as well, right? If we had done this calculation and determined that the value in use was higher than 177, we don't need to worry about fair value loss cost to sell. Why? Because the recoverable amount is the higher of fair value loss cost to sell in value in use. So if value in use was already higher than the carrying amount of the CGU, that means already run of an impairment. Even if the fair value less cost to sell was lower, then we don't care because we use the higher value, right? Recoverable amount is the higher of fair value less cost to sell and value in use. So if this amount had been higher, we don't care about fair value less cost to sell. In my discussion though, because remember, you are here to demonstrate your competence. So in your discussion, you would say, I note we have not. So if we imagine the value in use was, let's say, 180,000, you would say, I would note that we've not determined the fair value less cost to sell. However, it is not necessary because in this case, the value in use is above the carrying amount of the CGU. Therefore, there will not be an impairment loss as the recoverable amount is the higher of the two amounts. Therefore, as the value in use is higher, it indicates that no impairment is applicable on this, right, or on the CGU. So although it may be true that we might not need the fair value less cost to sell, tell me why you need to show me that you thought about it. You thinking about it and not putting it on your paper is not going to help you or me, because I don't know that you know what the recoverable amount is. I don't know that you know why we don't need to think about it. So you need to put this, you need to put your thought process on the piece of paper. It also says if we can't determine the fair value less cost to sell, but then again, ask the question. I note you have not included the fair value less cost to sell. Is it that we were not able to determine it? Can you provide indication of this, or have we tried to determine that calculation? Should we perform that calculation? Should we look for that information? So show me that you remember the principle, right? The impairment, an impairment loss exists when the carrying amount exceeds the recoverable amount. What we need to demonstrate that you know what a recoverable amount is. If you have not demonstrated that you know that there actually is a fair value less cost to sell component in the recoverable amount, I don't know that you know that principle. So tell me what you thought about it. Tell me why you think it's okay it's missing. Otherwise, you could have just forgotten. So I can't award that indicator to you, or I can't award it to anyone who didn't mention it, because I don't know if you forgot or if you made some kind of conclusion as to why it shouldn't be there. If you tell me what you thought about, I can award the indicator. Also using the inputs, we get a different amount. Seeing they use compound interest. Yeah. I typically would not do that. And it's strange. It's strange because usually, actually, these questions specifically tell you not to re-perform the calculation. Strange they didn't in this case, but yeah, it's interesting because I actually think we might, if we didn't tell you not to do that, we might have actually considered the indicator, but I just think we're required to review the calculations performed. Yeah, we might have actually awarded you the indicator because we didn't specifically tell you. But typically they will tell you not to do it. They'll typically tell you not to perform the calculation because that's not what we're testing. We're not testing, in this case at least, your ability to perform a calculation. We are testing if you know the principles that go into it, testing if you know how to apply those principles in the context of this entity. So the reperformance is not actually a key component or any component of what we're testing. All right, we need to show that it's wrong. Yes, exactly, Nombuso. Tandega, when you say I must repeat, the review steps. So I think what you mean there is what I'd raised about. In a review, we need to ensure that we perform a line-by-line review. Why? To ensure we get coverage. So we're able to identify more clearly all the items, all the issues identified. We need to assess for technical accuracy, or the accuracy of applying the technical principles, have the principles and apply it correctly, meaning you need to have a solid technical base. You need to assess for reasonableness. Does this make sense? When I do this, why am I doing this, right? Assess against your prior understanding. Is this consistent with what I understand of this business? So you bring in the business context continuously. If you take nothing else from today, I need to take the fact that the standard that is triggered does not exist in isolation. It exists to be applied in the context of the entity provided, in the context of the industry provided. You need to ensure that by the time you get to the IOD or the assessment day, you have tested your understanding of these principles in this industry. You have thought about the judgment that could be made. You have thought about the linkages. No standard exists in isolation. It is to be applied in the context of the industry. You're saying, please also answer this. If they'd mentioned, that we sell snacks on the flights, should have been inventory on the SOP, and if so, would then have been part of the CGU. So again, depends. Most likely, if we do sell snacks, probably would have inventory. Whether we'd allocate it to CGU is also a question, because how would we do that? Do we have specific inventory? So when buying Pringles and water, do we say these Pringles are specifically for this aircraft, or do we say, you know what, in OTA in a year or in a month we use this many packs of Pringles, so we're buying it for everyone? So would it be, can you allocate it to the CGU on a reasonable and supportable basis? So most likely in this case, you might not have been able to allocate it. So it's much easier in a non-airline environment. But if it is indicated that perhaps you could separate it, valid. You can also ask the question. So say, I noted inventory. I know we sell snacks. Have we included inventory because the snacks are actually set aside and the specific snacks that are only used for this aircraft or this particular, what should I say, route or whatever? A situation where that actually could occur in the airline industry, now that I think about it, is if we have certain aircraft that I don't know, that it's of a certain stature or certain caliber, that it's only used for certain flights. So higher end flights, more luxurious flights. So it's only on those flights we provide snacks. On all our other flights we don't, or all our other aircrafts we don't provide snacks. Then clearly that inventory can be allocated to only this flight that would provide the snacks. So it's very context dependent. Let's see where we are now. I think it's because, remember, the trade and other receivables are financial instruments. Yes, so that's also true that you can't impair financial instruments under IAS 36 as well. But remember I said, if they were allocatable, if you can allocate them on a reasonable, supportable basis, you would include them in the CG. So you'll ask the question, can these be allocated here? Do the results relate to all the aircraft? You would include them here and determine the total carrying amount. But when you allocate an impairment, if there's an impairment, you will exclude them because you cannot allocate an impairment to an asset that is measured under a different standard, that is outside the scope of IAS 36 for measurement purposes. So you cannot allocate additional impairment because ECL does that. Okay, there are too many questions now. I think what I will do now is respond to the questions after the class, because we have reached that point where I have hit my 9 o'clock deadline. I can even see my team's also telling me that I'm out of time. So I've reached my 9 o'clock deadline. Thank you all so much for being interactive and giving me your thoughts. Please, I hope what we've spoken about today, you're able to apply not just to other accounting tasks, but to other tasks in general, right? Bring the PRI IOD, bring the business context. I hope you've seen how business acumen comes into play. And Very, very key, critical thinking. Yeah, have a lovely evening, guys. Thank you for joining me and best of luck with the APC.
Thank you, Connie.
Thank you.